Fed meeting later this week where another big rate hike is expected. Joining us right now is Kevin Hassett, served, of course, as chairman of the Council of Economic Advisors under President Trump. He was also a senior advisor to the president. He's now a distinguished visiting fellow at the Hoover Institution. Kevin, good morning to you. If you could advise Jay Powell as to what he should do and what you think he will do.
Well, I think what they're going to do is they're going to give us 3/4 of a point rate hike. And what I would advise him is that he should do more than that. The fact is that inflation is now, if you look at like a rolling average over the last few months, running north of 10%. And that's the highest inflation we've seen. You know, I've been on Squawk Box for more than 20 years. We've never been in a time where we've had inflation like this. And we're also kind of in recession, right? So it's a difficult time. But they have to get ahead of the curve on inflation. They're going to give us 3/4 of a point. They've really shown that, you know, and talked about that over the last couple of weeks. But I think they need to do more because inflation is so high.
Kevin, if in fact they went as high as you want them to go, what do you think the stock market would do? And should it matter?
You know, I think the stock market wants to know that the Fed's serious about inflation. And I think 3/4 of a point is sort of just about there. But I think if you went more, the stock market might actually celebrate because inflation has to be under control. And the reason is that when you have inflation this high, it's really hard for output and all the other stuff to keep up with it. And so, you know, real incomes right now, year over year, are down about 4%. That means that real product has to be down about 4% because, you know, product eventually catches up with income. And so if inflation doesn't come down, then you're looking at negative GDP until inflation is down. And, you know, that could be another, 2, 3, 4 quarters. And so I think if they were to hit us hard right now, it actually might be something the market would celebrate.
Kevin, I want to play you a soundbite from over the weekend. This is Treasury Secretary Janet Yellen speaking about the R word, a potential recession yesterday on Meet the Press.
This is not an economy that's in recession, but we're in a period of transition in which growth is slowing. A recession is a broad-based contraction that affects many sectors of the economy. We just don't have that.
You buy that?
No, I think that's kind of unfortunate. And as you know, I'm an old friend of Janet's, and I have high regard for her. But I think in this case, if I were in the White House, I would not be out there sort of denying it's a recession. The fact is that the first quarter was big and negative. The second quarter, according to GDP Now and other real-time forecasts, is also going to be negative. We get that, basically this week. And then you got 2 negative quarters. If you go back to World War II, we've had 2 negative quarters 10 times. Every single time was in a recession. And so we're 10 for 10. And so for the White House to be in denial, I think is the wrong thing. If I were in the White House right now and I were advising President Biden, then what I would say is, hey, we're getting really bad economic data, and we need to basically get out in front of it, let people know that we've got the bad economic data that probably is a recession, but then we need to have a plan to fix it. And so I think that one of the reasons why they're in denial is they don't have a plan to fix it. And so they're just in denial. So they were in denial about inflation. Now they're in denial about the recession. And it's just not a good look. I think the American people expect politicians, Democrats or Republicans, to be square with them and to say, here's what's going on. But what do you make of the argument?
And even our friend Joe Kernan here was defending the administration to some degree in the last hour, saying, look, and I don't want to put words in Joe's mouth, but the idea of where we are in terms of unemployment in the country maybe gives you wiggle room, a lot more wiggle room than you think.
Well, I think that people are pointing at the jobs numbers and the low unemployment rate. But if you go back and look at the history of recessions, it's pretty common for those things to move a little later. And the reason is that there's a big fixed cost to hiring people, and you don't want to let them go the minute that you see bad news. And so it takes a while for people to start to have layoffs. But one of the things that you see is usually in about the second quarter of the recession, initial claims for unemployment insurance start to go way, way up. And when they hit 250, it's kind of like a barrier that I notice. And we just hit 250 last week. So I think that on the labor market, we're basically in a normal recession. And so the idea that the labor market is tight, but the rest of the economy is strong is not really an argument. That's just like an argument that disregards history. History is that labor markets, wages, and employment move slowly.